Have you noticed something strange happening in the gold market right now? Prices are dropping. Headlines are screaming panic. And yet, behind the scenes, something doesn't add up. Because while retail investors are selling in fear, the big players might actually be buying. So the real question is this a real gold price crash or just a fake dip designed to trap you? And before we go deeper, if you want to stay ahead of market moves like this and understand what smart money is really doing, make sure to hit like and subscribe right now. Because on the Gold Report, we break things down in a way that actually helps you stay one step ahead. Now let's get into it. Over the past few days, gold prices have shown sudden weakness. Sharp moves down, unexpected pullbacks, and a wave of fear spreading across social media and financial news. Many investors are asking the same question: is this the beginning of a bigger crash? But here's where things get interesting. Every time gold drops like this, there are always two types of reactions. The first group panics. They see red candles, they hear negative news, and they assume the trend is over, so they sell. But the second group, the smart money, they don't react emotionally. They observe, they analyze, and most importantly, they look at what's happening behind the price. Because price alone never tells the full story. Let me explain something that most people don't realize. Markets don't move randomly. They are driven by liquidity, positioning, and psychology. And sometimes, what looks like a crash on the surface is actually a setup designed to shake out weak hands before the next move higher. Think about it. If you were a large institution and you wanted to buy gold at a lower price, would you buy when everyone is bullish and prices are rising? Or would you wait for fear, for panic, for a dip? Exactly. And that's why these sudden drops often happen. Not because gold has lost its value, but because the market is creating an opportunity for big players to accumulate. Now let's look at the bigger picture. Globally, the fundamental reasons for gold haven't changed. Inflation is still a concern. Interest rates remain uncertain. Geopolitical tensions are always present. And central banks around the world, they are still buying gold. Yes, central banks. This is one of the most important signals you need to understand. While retail investors react to short-term price movements, central banks think long-term. And right now, they are still adding gold to their reserves. So ask yourself, if gold was truly crashing, why would the biggest players in the world still be buying? That's the contradiction most people miss. Now let's talk about the psychology behind what's happening. When prices drop quickly, it creates fear. That fear spreads fast. People start to believe that something is wrong. They start to look for negative news to justify the drop. And suddenly, the narrative shifts from bullish to bearish. But here's the truth. The market doesn't move because of the news. The news often follows the move. And this is where most retail traders get trapped. They see the drop, they hear the fear, and they sell at the worst possible time. Meanwhile, smart money is quietly positioning. This is what's known as a liquidity grab, a move designed to trigger stop losses, force weak hands out of the market, and create the conditions for a stronger move later. Now, I'm not saying every dip is fake. Sometimes markets do crash. Sometimes trends do reverse. But the key difference lies in confirmation. A real crash is usually supported by strong fundamental changes. A fake dip, on the other hand, is often driven by short-term sentiment and manipulation. And right now, many signs suggest that this could be more of a fake dip than a real crash. Let's break it down further. First, look at the speed of the move. Sudden, sharp drops are often emotional reactions, not structural changes. Second, look at the broader trend. Has gold completely broken its long-term structure? Or is it still holding key levels? Third, look at positioning. Are large players exiting the market, or are they quietly accumulating? These are the questions that separate emotional decisions from strategic ones. Now imagine this scenario. A retail investor sees gold dropping. He panics. He sells. He waits for lower prices. But instead, the market stabilizes. Then it slowly starts to rise again. And before he realizes it, gold is back up, and he's left behind. This happens more often than you think, because the market doesn't reward fear. It rewards patience and understanding. And this is exactly why narratives like gold crash spread so quickly. They create doubt, they create hesitation, and they keep retail investors on the wrong side of the move. But let's not ignore the risks. Even if this is a fake dip, that doesn't mean gold will instantly go up. Markets can stay volatile, prices can move sideways, and there can be more short-term downside. That's why it's important to stay balanced. Not overly bullish, not overly bearish, just aware. Because in markets like this, clarity is your biggest advantage. Now here's something very important. The difference between losing money and making money in markets often comes down to one thing: perspective. If you're only looking at short-term price movements, everything looks chaotic. But if you zoom out, if you look at the bigger picture, patterns start to emerge. And right now, the bigger picture for gold still shows strength. That doesn't mean there won't be dips. There will always be dips. But dips are not the same as crashes, and understanding that difference can completely change how you approach the market. Now think about this. If gold was truly entering a long-term crash, would we see consistent demand from major institutions? Would central banks continue buying? Would global uncertainty suddenly disappear? Or is it more likely that this is just another phase in the market cycle? A phase designed to test your patience. Because at the end of the day, markets are not just about numbers. They're about behavior. They test your emotions. They test your discipline. And they reward those who can stay calm when others panic. So the next time you see headlines screaming gold crash, pause for a moment. Ask yourself, is this real or is this just noise? Because sometimes the biggest opportunities are hidden inside the biggest fears. And if you can learn to recognize that, you'll already be ahead of most people in the market. Now I want to hear from you. Do you think this is a real gold crash or just a fake dip? Drop your opinion in the comments below, because your perspective matters, and these discussions help everyone see the market more clearly. And if you found this breakdown useful, make sure to share this video with someone who's confused about what's happening in gold right now, because chances are they need to hear this. Stay sharp, stay patient, and I'll see you in the next one on the Gold Report.